Bitcoin is back near $64,000, and that is exactly where the emotional trap gets stronger. After weeks of weakness, every green candle feels like proof that the bottom is in and the next move has already started. But the cleaner reading is more cautious. Price is recovering faster than conviction. At the calm metrics, that difference matters because price can move first, while real liquidity confirmation arrives later, or not at all. The latest completed ETF data showed 2 straight days of net outflows after a brief return of inflows earlier in the week. At the same time, Bitcoin held its recovery and pushed higher, which makes the move look stronger on the surface. Yet recent derivatives data showed open interest falling as price rose, while a large wave of short liquidations helped fuel the rebound. That does not make the rally fake, but it does mean part of the move came from traders being forced out rather than new buyers aggressively stepping in. This is where Wall Street psychology and retail psychology separate. Retail sees Bitcoin reclaiming a round number and feels regret for not buying lower, then urgency to act before the market leaves without them. Larger allocators usually need more than a green chart. They watch whether spot demand persists, whether ETF flows improve consistently, and whether participation expands without leverage becoming unstable. The market can keep rising without all those signals, but the quality of the move is different when they are missing. The mistake is turning one contradiction into a prediction. Falling open interest can reflect weak participation, but it can also mean excess leverage has been cleaned out, leaving a healthier structure. ETF outflows can warn that institutional demand is soft, but 2 negative days do not define an entire cycle. The point is not that Bitcoin must reverse. The point is that a price bounce and a confirmed liquidity shift are not the same event. So the calm question tonight is not whether Bitcoin is bullish or bearish by tomorrow morning. It is whether the next advance is supported by stronger spot demand, steadier ETF flows, and participation that rebuilds alongside price instead of merely chasing it. That is the signal beneath the noise, and it is the difference between reacting to a candle and understanding the market. The calm metrics will keep watching the liquidity because the price is only the surface.